The UK housing market is cracking, and almost nobody saw it coming. What's happening right now isn't just a price dip, it's a total reshaping of who gets to own property in this country, and who gets pushed out completely. Because while some areas are booming, others are quietly falling apart. And the reason? It's not just interest rates, it's something far deeper, a chain reaction that's about to hit every homeowner, renter, and investor in Britain. Let's break it down. The UK property market has split in two. Up north, you've got bidding wars, packed viewings, and homes going under offer within days. Down south, especially in London, you've got price cuts, empty open houses, and sellers slashing expectations just to get a single viewing. According to the latest data, property prices in the northeast have surged by almost 8% in 1 year. Meanwhile, in London, prices are barely moving. Some boroughs are actually falling. A 3-bedroom home in Newcastle might cost £180,000, while the same property in outer London still pushes £450,000 or more. The affordability gap has become a canyon. Even though salaries in London are higher, they're nowhere near high enough to justify double or triple the mortgage payments. And when you add commuting costs, council tax, and everyday living expenses, the numbers just don't make sense anymore. In Manchester, a £200,000 mortgage gives you a comfortable life. In London, a £400,000 mortgage gives you anxiety, so people are voting with their feet. Families are moving north. Young professionals are leaving the capital, and the cities that were once seen as cheap are suddenly becoming the country's hottest markets. But this shift isn't just about lifestyle, it's about survival, because something else is brewing, a financial shock that's about to hit hundreds of thousands of homeowners at once. Between now and 2027, around 800,000 homeowners will see their fixed-rate mortgages expire, most of them locked in deals at 2 or 3% during the cheap money era, when borrowing felt effortless. Now those same deals are resetting at 5 or even 6%, and the impact is brutal. Take a £250,000 mortgage. At 2%, the monthly payment was about £1,120. When that deal ends and the rate jumps to 5%, that payment shoots to £1,460 per month. That's an extra £340 every single month, over £4,000 a year, gone just to service the same debt. And that's the best case scenario. Because if you fall onto your lender's standard variable rate, 7 or 8%, your payment skyrockets to £1,750 per month. That's an extra £7,500 a year. For tens of thousands of families, that's not manageable. It's impossible, especially for those who bought during the pandemic boom in 2021 or 2022. They stretched their budgets to the absolute limit. And now those same buyers are realizing they can't afford to stay. This is why supply is suddenly flooding the market. Not because people want to sell, but because they have no other choice. And it's not just the homeowners, there's another group being squeezed even harder, the landlords. For decades, buy-to-let investors were the backbone of the property market. Now, they're the ones heading for the exits. In the past year alone, 19% of landlords sold a property, compared to just 8% who bought one. That's a massive net loss of rental stock. And new data suggests it's accelerating, with 41% of landlords planning to reduce or completely exit their portfolios in the next few years. Why? Simple economics. Their mortgages have doubled too, but unlike homeowners, landlords can't pass those costs fully onto tenants because renters are already stretched to breaking point. And then there's regulation. The Renters Reform Bill scrapped Section 21, meaning landlords can no longer evict tenants without a clear legal reason. That's great for renters, but from a landlord's perspective, it adds risk. If a tenant stops paying or damages the property, resolving it now takes longer and costs more. On top of that, the tax benefits for holiday lets are being stripped away from April 2025. That means thousands of small landlords running Airbnb-style rentals in places like Cornwall and Brighton are selling up. And when landlords sell, something strange happens. Rental supply shrinks, which pushes rents higher. But at the same time, all those ex-rental properties hit the market for sale, adding to the supply glut. So renters pay more while house prices fall. It's a bizarre situation, but it's exactly what's unfolding. In some areas, 1 in every 6 listings you see on Rightmove used to be a rental. Well-kept, ready-to-move-in homes, now selling because the numbers no longer work. For first-time buyers, that's finally creating opportunities. But for landlords, it's the end of an era. And it's only one piece of a much bigger problem, the collapse in confidence. You'd think falling prices would attract buyers, right? But the opposite is happening. Buyers are on strike. Transactions have dropped 28% year on year. And in some months, activity fell by 60% compared to last year. That's not a slowdown, that's a freeze. Sellers are listing, but buyers aren't biting. Everyone's waiting for someone else to move first. Buyers think prices will fall further. Sellers think the market will recover, and while both sides wait, the system grinds to a halt. Estate agents describe it perfectly. The market isn't crashing, it's holding its breath. And it's not just emotional, it's mathematical. When transactions fall this sharply, price averages appear stable because there aren't enough sales to pull them down. On paper, the market looks calm. Underneath, it's chaos. The real tension sits with the people caught in between. First-time buyers who want to get on the ladder but don't know if now's the right time. For them, it's psychological warfare. Wait too long and prices might rise again. Buy now and you could overpay by thousands. That uncertainty has paralyzed an entire generation. And if you think this crisis is bad, wait until you hear what's happening to those who bought through Help to Buy. Back in 2013, the government launched a scheme to make home ownership easier for first-time buyers. It sounded great until you realized it only applied to new builds. Developers saw a gold mine. They inflated prices by 10 to 15%, knowing buyers had government-backed loans. People thought they were getting a deal. They weren't. They were overpaying. Fast forward to today, and those same buyers are discovering their homes haven't risen in value. Some are even worth less than they paid. Imagine buying a flat in 2018 for £250,000, only to find out it's worth £230,000 today. After 7 years of mortgage payments, you've got less equity than when you started. Thousands of Help to Buy owners are now trapped in negative equity. They can't refinance, they can't sell, and they can't move. Developers are still at it, offering 5% deposits and free legal fees, but baking those costs into inflated prices. Buyers think they're getting help. They're not. They're starting their journey already underwater. While all this chaos unfolds, some regions are thriving. Manchester, Bristol, and Glasgow are posting real growth. Why? Because prices there still make sense. You can buy a 2-bedroom flat in Liverpool for under £120,000, rent it for £800 per month, and get an 8% yield. Meanwhile, in London, you'd pay £400,000 for a flat that rents for £1,800 per month, barely a 3% net return after costs. The numbers in the south just don't work anymore unless you bought a decade ago. That's why the smart money, the professional investors, are heading north. Buy-to-let mortgage applications actually rose 32% in early 2025, even as smaller landlords sold up. It's a clear sign that institutional players are moving in while amateurs bow out. The result? A market reshaping itself in real time. Wealth shifting from overstretched southern owners to strategic northern investors. So, where does this all lead? Because when a market this big begins to bend, the question isn't just when it will bounce back. It's who will survive long enough to see it. Analysts are cautiously optimistic, but not all for the same reasons. Some believe we're heading into a period of quiet recovery where the worst is already behind us. Others say the storm hasn't even hit yet. Let's start with what most experts agree on. The next 5 years will redefine British property ownership. According to projections from Savills, the UK housing market is set for 24% total growth between 2025 and 2029. Sounds impressive, right? But look closer. That number hides the story within the story. London and the South East, once the unstoppable engines of UK real estate, are forecast to grow by 15 to 18%. Meanwhile, the North and Midlands could surge by 30% or more. That's a complete inversion of the old pattern. where the South always led and everyone else followed. It's the beginning of a long overdue rebalancing. Why is this happening? Two words: wages and rates. By 2029, average wages in the UK are expected to rise by around 22%. At the same time, the Bank of England's base rate, currently sitting above 5%, is projected to drop gradually to about 4.25%. That might sound small, but the ripple effect is enormous. When rates fall even a single percentage point, the average mortgage payment drops by hundreds of pounds per month. That's the difference between people waiting and people buying. And once those buyers return, confidence spreads like wildfire. Estate agents start getting more viewings, sellers get bolder, and before long, the cycle starts again. But don't expect a sudden boom. This next phase will be slower, more cautious, and more rational than anything we've seen in decades. Because this time, buyers are battle tested. They've seen what happens when easy credit meets unrealistic optimism. They won't fall for it again, at least not soon. In London, the story will be different. Analysts believe the capital will remain flat until at least 2026. But underneath that stagnation, a quiet shift is brewing. International investors, especially from Asia and the Middle East, are quietly returning to the London market. They see opportunity where others see panic. A weaker pound, softening prices, and long-term prestige make London property look like a global discount store for high net worth buyers. Foreign investment is already up nearly 12% year on year, particularly in new build developments in areas like Canary Wharf, Battersea, and Nine Elms. It's not locals driving these sales, it's international capital flowing in quietly, betting on London's long game. So, what we're witnessing isn't the end of the UK housing market, it's the end of how it used to work. Cheap credit, blind speculation, and government handouts created an illusion of stability. Now the system's being forced to stand on real fundamentals: wages, yield, and value. And while that's painful, it's also cleansing. It's giving people who are locked out a shot at getting in. It's pushing weak investors out so the strong ones can build again. So yes, house prices are falling fast, but beneath the headlines, the market's reshaping into something fairer, leaner, and more sustainable. This isn't a crash, it's a correction, and like every correction before it, those who pay attention now will own the next cycle.